Wednesday, October 25th, 2017, Monaco 64, home of alternative economics and contrarian views. I want to look at the bond market today because yields are starting to move higher, especially for U.S. Treasuries. Before I go further, though, I like to say that I worked in the bond markets for over 20 years. First at a private bank in Switzerland. We did most assets, but the core of our business was bond markets, German government bonds, treasuries, mostly. And then when I came to work in Switzerland, I was a futures and options broker for institutional clients, for banks, fund managers, treasury departments. And the core of my business was the bond market. That's what I followed, interest rates, and especially government bonds, government bond futures and options. And, looking back to, let's say, 1994, 1995, back then, for example, 3-month euro lira, which was the Italian 3-month money, at the time had a double-digit rate, so above 10%. Remember trading the euro-lira contract on the Life Exchange in London, and the handle was less than 90, which means that rates were more than 10%. I remember, that German government bonds, the 10-year Bund, got up above 7%, excuse me, at one point. U.S. Treasury 10-year, usually trade around 6-7%, maybe high 5%. 30-year bond 6-7. 5-year, I remember in 1999 when the 5-year got down to 5. I was talking to your people in the market and said, "This is amazing, 5%, in the 5-year." And now, for example, we are moving back up in U.S. Treasury yields. That's why I wanted to talk about a bond market today. And I haven't been speaking about the bond market lately, but if you go back on my channel, and I'll put the 2 videos I did last year about the bond markets on the cards up here. One is from July 2016, and it says, "Is the 35-year bond bull market over? Have interest rates bottomed?" And just then, 2 weeks before, I think the 10-year yield got down to 133. So I think they have bottomed longer term. And then the other video I made is the 35-year bond bull market over? Asking the question again. That was October last year. It looks like it has, unless, we get another financial crisis and people rush to treasuries, but maybe they won't. I don't know. We'll have to see. But one amazing thing that's happening, and I think Jeff Gundlach was in a video or an interview with Vanity Fair earlier this week or last week, and he was talking how European bonds are just like, it's not a real market. It's totally manipulated by the ECB. He was showing how, high yield or junk paper from Europe is yielding as, the same as U.S. government paper. And he says that doesn't make sense. And I agree with him. But at the moment, markets are being manipulated and controlled. But I don't think central bankers can control it forever. They can influence it and manipulate it. But if they could control it forever, everything would be perfect. And and we know very well that things, historically have not been perfect. You need instability in markets. You need like ups and downs. That's how the free market works. For example, as I said, if someone told me back in 1995 that by the year 2017, Italian 10-year yields would be lower than U.S. 10-year yields, I would laugh at them. And especially if they said that the Italian 2-year yield would be at 2.05%, like it is now. So there's definitely something wrong there. But now I want to focus on the on the US Treasury market or government bond market, because that's, you know, still the main reserve currency, the US dollar. So everything is priced off the 10-year yield. A lot of stuff, a lot of, you know, it's considered a risk-free rate of return. And, you know, stock markets, commodities, everything, a lot of stuff is priced off that because that's the price of money. So right now, the 10-year yield is at 2.45%, and it's gone up 23 basis points in the last month. And the interesting thing to to remember is that as bond yields go up, the price of the bond goes down, because you have to remember there's a secondary market for bonds. And some speculators, some funds, they buy just for the capital appreciation. So if the yields start going down, that means it's bad news for people who hold the bonds and need to sell it. They're going to lose a lot of their capital. So, yeah. Up 23 basis points in a month. That's quite a big move. The 2-year note, which is, you know, shorter term, of course, that's up 18 basis points in the last month, and it's at 161. And the Fed, you know, their target rate is the Fed funds rate, which is like an overnight rate between the banks. So if the 2-year rate note yield starts going up, you know, the Fed has to follow, and that's why they've been raising rates. The market is telling the Fed, you know, they can't, as I said, they can't control it, they can influence it, but if the market's gonna, you know, start selling US paper, yields are gonna start going up. So let's have a look at the charts. I'm gonna bring up a 10-year note chart here. So it's a kind of a 1 year frame, and you can see here that we bought in just above 2% in the end of September, and it's actually been going up fairly steadily since then, and we've broken you know, above this 240 yield. But the key levels are, you know, the top from late last year and earlier in March this year, when we got up to around 263, 265. You can see there's a double bottom there. Until we get back above those levels, you know, this is just normal market move. But I just thought it'd be interesting to, you know, show people what's going on with the bond market. And longer term, here's another chart of the 10-year. You can see how important that level just above 260 is, because once we break through there, it could be a very quick move up to the high around 3% in 2014. So is this a sign that the U.S. economy is doing a lot better? That you know, the economy is going to grow more, and you know, there's going to be more tax receipts, smaller deficits for the government, and they'll be able to finance this debt? Or is it a sign as well that the rest of the world is trying to move away from the U.S. dollar a little bit? You know, trying to move. You know, not depend on the dollar so much. I've spoken many times, you know, about the petrodollar, how the Chinese, the Russians, and other, you know, developing countries or the BRIC countries are starting to try to trade more with, you know, bilaterally in their own currencies. So what that means is that instead of having to have dollars to buy everything, you know, to make payments or to trade with other countries, people won't need as many dollars. Sovereign countries won't need to hold as many treasuries, and they won't be putting those, or many dollars, sorry, and they won't be putting those to work in the Treasury market. That could be a sign of that as well. So let's look now at the 2-year. You can see there 140 was a key level, and now, you know, it starts going up. That's why I think the Fed will raise rates in December. they're behind the curve. And I think personally, the reason why the stock markets keep going up is because the Fed, monetary policy is still too loose. If the Fed doesn't hike, things could get out of hand, even more out of hand. And this is what the market's trying to tell the Fed, in my opinion. So we're almost at 160. Let's see where we are right now. An update. 161 already. The 2 years gone up. I did these charts last night. So we're already at 161 in the 2-year note. So this is very interesting. This is the market telling the Fed, you're behind the curve. You guys need to raise rates. So longer term, just to give you an idea of, where 2-year yields have been before. You see, before the 08 crisis, we were, between 4 and 5%. So where we're now is still very low, but it's moving up. So what about the markets? What's going on this morning? Quickly here. Gold is 1273.20. We've been down to 1271, down 3.5. Silver 1685, down 5. Range has been 1680 to 1698. The Dow is up 11. S&P is down 2.25 points. The NASDAQ 100 future is down 8. And in the currency market, the big move has been the pound. The pound is up 0.82% at 132.43, up 108 pips. And why is that? Well, we had UK GDP data. It was expected 0.3 and 1.4% quarter on quarter and year on year, 0.3, 1.4. And it came out 0.4, 1.5. So 1 basis point, 1/10 better. And the pound just moved up, 0.8%. There's talk now that the Bank of England is going to raise rates. But don't forget, we're still at 0.25%, the base rate in the UK, the Bank of England rate. So, excuse me. So that's what I wanted to talk about, the bond market, and how it's, especially U.S. bond market is starting to show signs of rising, yields and falling prices, and that could be that could create problems, because that's the cost of financing, and that's what's driven, the credit boom that we've had since the early 80s. So if you enjoyed this video, please like, share it, and also subscribe to my channel if you haven't yet. You can also follow me on Twitter and on steemit.com. And I'll talk to you later. Bye.